Okay, good evening, ladies and gentlemen. Thank you for coming for today's session, and I will share with you a new trading instrument called Singapore Depository Receipt, or SDR in short. And there are three SDR that are available now for trading. And in particular, I want to share this one called CPO. And it's an interesting stock, and you might be able to relate quite well, right, as I go through it. So along the way, if you have any question, you can just use this pigeonhole and you can type in the question, and later we can go through at the end of the session. So this is the URL and this is the passcode to use in order for you to ask questions. I think they will keep the site TVs with the QR code and the link, so you can anytime when you're ready to ask questions, you can just type it in. Okay? Yeah, before I introduce myself, I'm Alvin. I'm one of the SGX Academy trainer. I'm also the CEO of Dr. Wealth. So you might have seen me in some of the YouTube videos as well as read any articles from Dr. Wealth. Okay, let's begin. Usual disclaimer, because it's basically my opinion when I talk about CPO. I don't take it as financial advice. It is meant for information purposes only. And this is the agenda for today. I will business segment so that you can understand better, right? Because I guess a lot of times when investors look at business, you might find it hard to analyze, right? What is important? What do you need to look out for? And we also look at some financial performances, okay? Mainly the financial metrics to evaluate whether they are doing well or not in terms of their operational performance. And we also talk about growth areas, right? Because when you buy a stock, you also hopefully can see some growth out of it. When the value of the stock goes up, that's where the share price can go up in tandem. And they also released their first quarter results, so we also want to do some update because mainly I'll be using the FY 2022 results to discuss. But since they have a first Q results out, we will also give some updates on that. And we also talk a little bit about the valuation, what I think about whether the stock is overvalued, undervalued. And of course, lastly, we will also spend some time explaining what this SDR mechanism is. And of course, if you have any other questions, you can ask thereafter. Okay, so as I mentioned, this SDR is a new instrument, and basically a simple way to understand what SDR is, it allows you to invest in overseas stocks without you needing to use a special brokerage or to go to the foreign stock exchange to buy. You can just conveniently buy it via SGX ecosystem. So that is in a nutshell what this SDR for you. And for a start, there are three Thai SDR, right? CPO, Airports of Thailand, and this is an oil and gas company called PTTEP. And of course, today I'm just going to focus on just one of them, right? So that we have enough depth, enough time to cover more details about the company so that you can know deeper level. Okay, so I always like to show this because I think this is the most obvious connection you can have with related company, right? They are not exactly the same, it's related. I believe you guys have seen this in the supermarket before, right? Do you all like the food? Do you like this brand? I see some nod their head. Okay. Personally, I think they're overpriced. there are cheaper versions, there are cheaper alternatives. Okay, so I don't particularly buy, but I guess this is what you guys have probably have can relate to, and this is based on Forbes Richest. You know, Forbes is famous for ranking billionaires and the richest in each country. So in Thailand, these are the 10 richest. Anyone related to these 10? No? Oh, okay. Never mind, right? Don't worry. Next time, maybe you got a chance to make friends with them. And probably you will see Thai beverage, right? This is also listed in SGX. If you go Bangkok, you should have gone to Central Mall. Red Bull, right? All these are quite well-known names. King Power is the duty-free. Okay, so these are the top 10. And of course, the number one guy is this guy or the family that own CP Group, okay, which is related which is the parent company of this brand. Okay, so this CP Group is a huge conglomerate. Its business span almost all the sectors of industry. Right, they have today we're going to focus on the retail and distribution, which is the CPO. Okay, just now when you look at the foods, right, it should be this part. This is where the one of the brand is the CP brand of the food, and they also have telecommunication through mobile. Okay, they have e-commerce, property development, automotive, pharmaceuticals, investments. They have a big stake in Ping An insurance as well. So you can see their industry and sector span across almost every tentacles of the economy. So this is the whole thing is called CP Group, but you cannot buy CP Group because it is a private company. Okay? The only way you want to buy it is you go to this fella and ask him to sell to you, right? Which is very unlikely because he doesn't need to sell to you. He has a lot of money. Okay, so today we're going to just talk about these slides, right? CPO, which is the retail and the distribution arm of the CP Group. And if you take a look at the shareholding, right, this is the relation to CPO. So CPG, which is CP Group, owns 35% of CPO, right? So it is the biggest shareholder of CPO, basically, right? There's other shareholders. There are many funds. Okay, probably these are like State Street is probably an ETF manager. So on behalf of investors, they buy into the this company, and that's why they have some substantial stake over there, right? But if you take a look, they are all not really commercial. Okay, not saying not commercial. They are not like another company or another big individual that owns CPO. So it's mainly CPG that's controlling the CPO. All right. And this 35%, it depends on how the accountant classify, right? It depends on how much control the CPG have over CPO. So if they have influential control, which means they even control the management of CPO, who to appoint as directors, then this CPO will be considered a subsidiary of CPG. Okay, so that's the relationship that we are looking at. So what is this CPO? It is the first business that we're going to talk about is that convenience stores, and 7-Eleven is a well-known convenience store. Even in Singapore, it's very common. In Thailand, it's even more common. Okay, and this CPO has exclusive rights to operate 7-Eleven in 3 countries, namely Thailand, Cambodia, and Laos. That's 3 out of 10 countries in ASEAN. All right, and what's so special about this is, okay, because the number of 7-Eleven stores in Thailand is really a lot. Okay, 7-Eleven comes from Japan. The brand comes from Japan, and naturally, Japan has the most number in the world. And surprisingly, is that Thailand is number 2. Okay, so it is the country with the largest number of 7-Eleven stores outside of Japan. And even countries like USA, China, where the population is so much bigger than Thailand, and yet Thailand has more convenience stores than them. In particularly 7-Eleven, right? Because they can have other brands of convenience stores as well. But this is the key difference. So Thailand, you can see 7-Eleven is a very important part of their life, right? Why? Okay, so one surprising fact is that 1/3 of grocery sales actually bought through 7-Eleven. Okay, any one of you buy grocery from 7-Eleven? In Singapore, right? We don't have the habit, right? We'll just go to the supermarket because it's cheaper, we have more variety. But in Thailand, it is their way of life. They actually go to 7-Eleven to buy groceries. Okay, which is very different. Another country, I cannot say country, very sensitive topic. Another place where there's a lot of grocery shopping from 7-Eleven is Taiwan. Okay, now you know why I must choose my word carefully. Okay, but luckily I'm not in China. So Thailand is one of the highest in the world, basically. And there are several other reasons. One is that their average household size have decreased. okay, and which means that they don't buy in a large amount anymore. So they buy in small amount, and going to a convenience store it suffice already. Don't need to go to the supermarket to buy in bulk to save money. And third is that the price gap between 7-Eleven and supermarkets have narrowed quite significantly in Thailand. It's not the same as Singapore, right? Because you have to imagine, you cannot imagine Thailand is the same as Singapore when they do all this grocery shopping, right? So we have to really think in terms of their shoes. And for us, yes, the price gap between 7-Eleven and supermarket can be big, but in Thailand, it is not. It's narrower. Okay, so they don't need to spend time traveling to the supermarket to save money. Okay, and the fourth is that proximity to homes and office. Thailand is a much bigger place than Singapore. Singapore is very convenient, right? Any neighborhood you stay, very likely, right, you have a few supermarket accessible to you. You want NTUC, you want Sheng Siong, you want, I don't know, Ang Mo, whatever. So you will have quite a number of choices that you can have in your neighborhood. You don't need to travel very far. Maybe you just walk 5 minutes, you reach a supermarket. Okay, in Thailand, you don't have the convenience of 5 minutes you go to a supermarket. Okay? Because the distance between homes and supermarket, or even like their city center, is very, very far apart. It can be an hour's drive away. And imagine you just want to go to a supermarket to buy butter. You can't possibly be driving 1 hour to just go and get it. So that is why this 7-Eleven becomes a very effective distribution network for Thailand, for a more sparsely household kind of a country, right? So that's where they just, okay, I can just go to the convenience store, 7-Eleven, to buy the butter, and I can just go back home. Maybe it's just a 5 minutes bike ride, right? So that makes it very convenient. And considering same thing, price gap has narrowed, there's less incentive for me to travel out so far. All right. And lastly, the 7-Eleven is also very different from our 7-Eleven. They are very well stocked. They have all sorts of things. They have vegetables. They even have pharmacies, right? Equivalent to imagining our 7-Eleven have Guardian or Watson inside. Okay, that is how their 7-Eleven look like. All right, so you can get your medicine there as well. So they resell all sorts of things. Okay, so that is the 7-Eleven business. And another good news is that in Thailand, although there are a number of convenience store brands like 7-Eleven, like Lotus Go Fresh, Family Mart, you have heard of it before, right? That's also from Japan. Top's Daily, maybe not. And then there are also those mom and pop, individual indie kind of shops that they open. But majority is 7-Eleven, right? 74%. So it is a dominating market position. And as investors, this is what we like to see, because you want to buy the best. You want to buy the number one player. You don't want to buy the second, third, fourth player, right? Because the dominating player has a lot of say in the market. They have economies of scale. They have network effect. They have pricing power, branding power as well. So that is why when you want to choose a business, usually you buy the pole position. And in this case, 7-Eleven is number one. And not only that, this Lotus Go Fresh also belong to CPO. Okay, so you add this together, they have more than 80% market share in Thailand. So that is a very powerful position, not easy for any other players to come in and steal market share, right? Because it does have network effect, especially when you think about, I don't know whether they have loyalty plans or things like that, but it's very common even in Singapore, right? A lot of even supermarkets, they have loyalty plans so that to encourage you to come back and spend more in the future. So I do think that this is an example of network effect, because you will start to think about, oh yeah, I also, if you want to get a membership plan or what, right? You also want to think about, will you use it frequently? Is there a shop that's close to you that you can use it, right? So with that idea, if there is 7-Eleven all over the place, it's a lot easier for them to stick to a loyalty plan, collect more points, get more discount, because they have a 7-Eleven near them. So it becomes like a flywheel, right? So they get, it's very ubiquitous, so they spend more, and then they go into loyalty, and then they get retained in the ecosystem a lot longer. So that is the idea of having a very dominating position in the market. And they are still growing, right? Last year, they have 42 stores in Cambodia, and then this year, they plan to open their first store in Laos, 700 more in Thailand, and 58 more in Cambodia, right? So you'll make about 100 this year. So they are still growing in size. And even in Thailand, even though there are many convenience stores already, they are still expanding another 700, right? So you can see that there is some growth. It is not that they are just stagnant, even though they are dominating the market. Next business is the supermarket. And supermarket, there are two types. One is the wholesale supermarket, and the other one is the retail supermarket. What we are used to is the retail supermarket. Okay, that is the Lotus brand. That is the retail supermarket. And some of you who travel to Malaysia, to buy cheap groceries, you might end up in Lotus, right? Because there's also Lotus supermarket in Malaysia, in two countries basically. Right? You can see Thailand is 2,600 stores. In Malaysia, it has over 50 stores. Okay, so they do have presence overseas, not just in Thailand, and that's the retail side. Macro is the B2B side, yeah, or they call it a wholesaler. Even though it's B2B, right, it doesn't mean that you cannot go there and buy. You can actually go there and buy, but just that you have to buy in bulk, okay, cartons and cartons. So if I can give you an example, right, Lotus is like Walmart, okay, Macro is like Costco, okay, so one is wholesale, one is retail. They're just different. In Singapore, last time we used to have wholesaler. If you all remember Big Box, anyone recall? The one at Jurong East? No? You all don't recall? That's why it died. Because you all don't go there and buy. Okay, so they sell in bulk. So apparently, I guess because Singapore household too small, and house also very small, right? How to store so many things? Okay, I think wholesale makes sense only in big countries where it takes a long time to go and get your stuff, and you just want to go at one time and bring back all, and your house is big, right? Because in big country you can afford more land. Singapore wholesale kind of business, I don't think it works. Costco kind of business doesn't work. Otherwise, Costco will already be here already, right? And big box won't fail. Okay, so you get the idea. And this in quite a number of countries, right? Thailand, Cambodia, India, China, and Myanmar. Okay, but the number of stores are very small overseas, right? So I probably won't even say that they have succeeded in their overseas expansion. I still have a lot to prove. But in terms of Thailand, they do have that presence already. Okay, so that is the Macro and the Lotus. That is the supermarket arm. And something that you might want to know is that 2 years ago, they did a restructuring. Okay, looks like a lot of complex web of companies, right? Yeah. Okay, don't need to take because I think you take already. When you look at it, you also won't understand what it is, because when you look at it, I also won't understand what they are talking about. Okay, but the key thing is this, right? Because the key is this red box. Okay, the rest of the boxes you don't need to care. It just confuse you even more, right? And this is only just the relationship with CPO. Okay, imagine you map out the entire CPG. I cannot imagine how they can handle it. How many subsidiaries they have. Okay, so this is CPO. Okay. This is CPO. On the left is before, on the right is after. Okay, so what happened is that Macro used to be a separate company, and Lotus used to be a separate division. Okay, separate company, not even division, right? So they are not related. So what the restructuring does is that they put Macro and Lotus under one group. Can see? That's all you need to know. Okay, that is the restructuring. All right. Why would they want to do that? Okay, for laymen like us, usually we don't know what's the real reason why they want to do this restructuring. Because once they do this restructuring, there was a lot of changes to the shareholdings. Okay, let's not go to the details. Based on what the management say, why they want to do this restructuring is that they want to remove some layers, but to me, the layer look the same. Still like kueh lapis, like that, many layers. Then increase synergy between wholesale and B2C business. Okay, this one I buy, right? Because you keep into one group, that means you have one management overseeing two businesses. Yeah, I think that makes sense, right? The synergy makes sense. And they say that they have the right structure to expand overseas. So maybe it could be a case because of better synergy. Maybe you can even have more economies of scale, right? When you order stuff, okay, then press down prices further when you import from other countries. So I guess it's more synergy than really removing layers. Okay, so still has some merits to it. All right. Next thing, we want to know which is a better business. Okay, in terms of revenue, right, which is on your left. Okay, how to read this? The green color is your 7-Eleven and your Lotus Go, and this orange is your supermarket business. Right? Ignore the others. Okay, so you can see that in terms of revenue, the supermarket arm contributes more revenue than the convenience store. Okay, and in terms of earnings before tax, the green one again is the 7-Eleven and the orange is the supermarket. So which one make more money? Which one generate more profit? Is it the convenience store, supermarket? Convenience store, right? Because it's 48%. Supermarket only generate 38%. Okay, and if you take these two diagrams together, right? Because you must be able to, when you look at this number, you must be able to interpret. Cannot be you look at the number for fun, right? Okay. So at least now you know which is the revenue driver, which is the profit driver. Okay. The other thing that you want to take out from this is that if the convenience store is 42% revenue, but it generates 48% profit, okay, versus the other side, right? Which have a higher margin? Which is a higher margin business? Convenience store, right? Correct. Okay. So I guess it's almost probably even 2 times more. Okay. So it's more profitable to run a convenience store than a supermarket. Okay. Supermarket makes your revenue looks nice because the volume is big, the number is big. But when you minus all the expenses, you end up at the net profit is going to be smaller compared to a convenience store business. Okay, I don't know whether is it the same in Singapore, right? I presume it's the same, because in Singapore your 7-Eleven you can charge higher, right? Naturally your margin is higher. Okay, supermarket usually you have to price lower. Okay, so if given a choice, you want to start a business between supermarket and convenience store, which one should you start? Okay, leave that question to you. All right. Because that's, I mean, from an investor perspective, that's what you want to analyze, right? You want to figure out which is a better business. Okay, the convenience store is a better business. And this is the revenue for the past 5 years for CPO. Okay. Again, there are a few things you can take away from this, right? So I also hope that you all can read beyond the numbers. You all need to interpret what does this number mean and how does it impact you in terms of your decision-making process. Okay. So most people, when they look at this, they'll see that, oh, okay, go up, good right? Correct. Go down, bad That's the most surface level of analysis. Okay. Right? Everybody can see that. That doesn't give you an advantage over other investors. Right? You must see more than what other investors see, right? If you don't, you will lose to them. Very, very easy. So a few things, right? Why did this revenue suddenly jump? You must ask that question. Correct or not? Why so many years never go up, but then 2022 jump? Okay, very good. Because of this restructuring. Remember? So macro and this add together. So and plus the shareholding, all this, they clean it up. That affects how they did their consolidation figures in the accounting statements. Okay, so which means this is not really an actual operational gain. This is more accounting cosmetics. Got it? Yeah, that's the first thing you see or cannot see. Can the gentleman can see, okay. Then second is, what happened in 2020? Anyone remember? COVID, right? Okay, so COVID, and the revenue did drop, right? Did drop a lot? It didn't, right? So what does it mean? What does it tell you about the business? Is it resilient? Yes. So another thing you want to see is a lot of companies in the past 5 years that include the COVID period, how much of their revenue were impacted? Majority of companies, if you see, right, got impacted. And those that get very little changes, as though COVID has never happened, these are your company that can survive most crises. Make sense or not? Okay, so you can see, right, it's just 5 bars, but you can actually make a lot of inference if you know how to interpret the numbers. Okay, otherwise, or go up good or go down bad, it's not that simple. Right? You have to piece the story behind the numbers. Okay, so there's 2 things you can see from here. Next thing, net profit go down. You're bad, correct or not? Then you'll skip the stock. Okay, again, you have to put the picture behind the numbers, right? Figure out why. Okay, understandably, 2020 we already established that it's COVID. 2021 likely still under COVID influence. Okay, and having that bigger expenses, lower profit for that 2 years, I think is understandable. It's excusable, right? At least they still turn a profit. How many companies during COVID can turn profit? Okay, so still not bad, right? Then 2022 is a restructuring issue, right? It's because, of course, you want to go and figure out why did the profit drop. And that's where you go and read some of their management discussion, right? What is the cost that they attributed to? Okay, but of course, don't take it as face value. You also must sense make a little bit, right? And they did say for 2022, right, a lot of these expenses were due to the restructuring, okay, when they merged together. And if you recall, the supermarket business, is it a high margin business or low margin business? Low margin business. So when they merge together, likely the profit will drop, you see, right? Because Macro was the wholesaler business that lumped together with everything. That drags the convenience stores figures lower. Okay, so you can see they explain, right? Mostly are due to the add-on costs that they carried over. Okay, because the margin is not as high as the 7-Eleven stores. So that affects the net profit. But the other way to look at it is that restructuring costs usually is transient. That means they're not permanent. And just now we talked about synergy, which means if they are able to do more things with less people, what will happen? Not so nice. They may let go people, or they may redeploy people elsewhere. That saves costs, right? Eventually, that profit margin will improve. Okay, because restructuring cost is temporary. It's not permanent. Of course, that also depends on how good or how well the management is going to manage these costs going forward. And that's what you want to see. Okay, their quarterly reports. Are their net profit or their margin increasing? All right, then you can see whether the synergy is working or not. Okay, next one. Do they give dividends? They do. Okay, before COVID, very nice. Every year go up, right? And this is a sign of a good, steady business because it has the ability to raise dividend on a consecutive basis. And then 2020 drop. Okay or not? Okay or not? Why drop? COVID, right? Okay. So this is fine. Still give dividends, not bad. Okay. And 2021, can see the lingering effect of COVID didn't really go away, right? Because never really fully reopened, gets impacted some more. Then 2022 shows some improvement. That's a good sign. Okay, but of course, the margin need to improve further for them to increase the dividends going forward. Okay, so that is the picture, right? But I would say overall still not bad because they still managed to give during COVID. Okay, resilient. So now let's go to the latest first quarter update. Okay, and generally, when you look at the surface, it's good, right? All up, 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 up. All right. Again, now let's try to interpret the figures. First, revenue go up from a quarter ago. This is likely a good sign because they have probably compared the new structure with last year. Okay, so this is a real revenue growth. This is a real operational growth, not accounting growth. Right, so this is a good sign. Second, did profits grow? Yes. Okay, did the margin grow? Just like I told you, right, it's important to watch in the next few quarters whether the margin improve. Okay, because restructuring cost is supposedly temporary, which happens to be lah, right? Because the margin is improving. And so the management did some work lah, right? They did manage to control the cost. Okay. And this is another way to look at it, correct? So first quarter versus last quarter versus a year ago, it has shown 19% improvement in net profit. Okay, so which also means that if they continue this trend, right, it is likely that this year's profit, FY23 profit, will be higher than FY22 if this trend continue. Okay, and that also shows that the recovery is in progress. Right, and that's what you want to see as an investor. Okay, it's okay to go down because of certain events like COVID, but what do you do after that? That's the next important question. So they managed to show some turnaround that's coming. And this is the store update, right? So they're still on target. Now there are 54 stores as of Q1. They have another 46 stores to go in for the rest of FY23. And the Laos, not yet. Haven't seen the first store yet. Okay, so I think they opened 2 more in Q1. Just now it's 52, right? As our end of 20. Oh, 42. So they opened another 10 more already. Okay, Q1 they opened another 10 more. 12 more, sorry. They opened another 12 more. Yeah. So they did some work. Okay. And now let's look at the financial metrics. Right. So we're going to talk about the valuation a little bit. Okay. The revenue growth, there is, but take note that this 5-year revenue will take in consideration of the restructuring gains. Okay, so it may not be a full 12%, but lately the first quarter result is also a double-digit percentage gain, right? So it might be able to fulfill this number. And in terms of valuation, there are, of course, many ways to value a stock. Okay, valuation is an opinion, just like analysis is an opinion, how you read things, how you think that is relevant. So for me, I usually prefer a composite of financial metrics, right? Don't just use one. I know P ratio is usually the popular one. Okay, P is important because we want them to make money, right? And we talk about margin is important. So P is a relevant number. And also want to look at the cash flow yield. Right, because you don't just want to look at earnings alone because earnings is paper profit. You want to have real cash backing them. And usually for supermarket business and convenience store business, right, they are fine. Okay, their cash flow is very good one. Why? They take money every day. Okay, yeah. So actually, it's a better place to rob than a bank. Don't say I say one. Okay, so they take cash, and you know a lot of the items, right? Some of them are consignment one, right? They don't even pay for the merchandise or pay for the stuff. They put it there. Like for example, sometimes you go to the supermarket, right? You see maybe a Magnolia staff packing the milk. Have you seen before? Right? So they don't even use their own stuff to pack. They get the you want to use my space. So the supermarket become like a renter of shelf space. You want to rent at a prominent spot, cost more. Otherwise, you put at the bottom or the top. Okay, so that's how they operate, especially the fast moving consumer goods. Right? So they're on consignment. And which means when the staff put the milk there, NTUC or Sheng Siong or whoever, right, don't even pay them immediately. So when a customer go to the cashier, they pay, the supermarket take the money. 30 days later, depend on credit term, then they pay Magnolia. Then what do they do in the 30 days? They take the cash, put in fixed D, maybe short depository. Then they make the interest with so much cash. Good business, right? Yeah. So that's how usually cash flow is not a problem for this kind of business. Okay, so I'm not so concerned about cash flow, but you still want to compare to the share price line in terms of the yield. And then lastly, because it pays a dividend, so you can also compare the dividend yield. So that's what I mean. I prefer to use a composite of metrics rather than just one. And based on what I can see, they are quite close to the average. So usually I'll compare to the 5-year average to give me a sense. So P at 43 times, and the 5-year average is 38 times, so it's slightly above. And free cash flow is also slightly above its 5-year average. Dividend yield is also slightly below. Sorry, this is slightly above means good, means cheaper. Below means more expensive, right? Because this is in percent. This is in multiples, right? So it's a reverse. Okay, so roughly it's about fair value. Right? It's neither overvalued, neither undervalued. Right? So which means the market priced it quite well. Okay, I add in this debt part, right? The debt to equity is high. Okay, 400% is considered high. But for this business, again, I think it is fine because of the negative cash conversion cycle. They always collect cash and pay later. So they will never run into a solvency issue. And another thing is that they own the supermarket space. They need a lot of real estate. Yeah, and it's likely they gear up. And usually you take real estate mortgage loan, right? The interest is generally lower than any kinds of other loans. Right? So it is part of the business. They need to gear up to get a supermarket space. Okay, so I think that is fine, right? But not okay if it's like, I think oil and gas company where it's cyclical in nature, right? 400% is too high already. Okay, oil cycle down, won't be able to pay the debt one. Okay, so a lot of other business may not be able to do that. Stomach of 400% debt to equity ratio. Okay, so that is from the fundamental viewpoint. All right, then the next one is that let's look at this first. This is the past 5 years share price movement. Okay, so you can see the share price movement past 5 years has not been doing well, right? Minus 15%. After COVID happened, you can see the share price crash all the way, quick rebound, then crash again, then range bound for another 2 years. Okay, so from a simple technical analysis, right, when you look at the price, right, which means that the share price is still somewhere around where COVID low is. The share price has not recovered, which also means that prior to the COVID, the share price run up here, this is very overvalued because now it's fairly valued, correct? Now it's fairly valued, right? Which means this is overvalued. Okay, but the good sign is the full recovery has not been priced in yet. Next, let's zoom out to 10 years. Over the 10 years, it does exhibit growth, right? 110%, 111% total return. This is inclusive of dividends, right? Compound about 10% per year, probably 9 to 10% per year, right? Total returns, which is quite decent return of quite a resilient stock. Okay, so which means it's really just trying to resume its bull market recovery. Okay, so I think this is a fair price to pay at this point in time. Of course, the resulting effect, whether the share price will go up, depends on, I would believe, mainly two things. First, overall Thai market or even overall Asian market must be bullish. Okay, because the macro picture has to be bullish in order for the individual stock to go up. So that's one. And second is the fundamentals of CPO must continue to improve. All right, which this is encouraging. Okay, this is encouraging. Because you think about this, right? If the profit continue to go up, what will happen to the PE ratio? If the profit continue to go up, what will happen to the PE ratio? It will drop, right? Correct or not? Okay, so which means it will become cheaper. Okay, so as they recover fundamentally, right, at one point in time, if the share price don't move, they will become cheaper. They will become undervalued. Okay, even if the share price stays stagnant, because they're fundamentally improving, right? So usually from a bottom-up angle, it's easier for investor because you can see the fundamentals improving. You're getting a better deal at a particular price. As for the first reason, right, can the Asian market recover, right, or turn more bullish? I wouldn't say Asian market did recover a bit. Right? And of course, it depends on which Asian country you're talking about. If it's Japan, then they have done very well. Okay, but majority of the Asian market are still pretty much probably below the COVID highs. Okay, so there's still quite a lot of room for recovery to happen. Right? Whether will that happen, it depends on a lot of macro factors. Okay, and also how the Western narrative in Asia is going to play out. Right? Because the West still hold most of the fund flows, hold most of the investment dollars. If the West have a narrative that's anti-Asia, which tends to be the case nowadays, okay, you will have the lack of fund flows to Asia, right? Because the West determines where money is invested, and they hold a lot of that power. But today, it's quite a good day for China. Okay, the market has been very bullish today. Hopefully, it's sustained. If that's sustained, then I think Asian market may see another leg, right? Asian market saw a bull leg from last year, October to January this year. Okay, then after that, it sideways or drop a bit for 6 months. Maybe there's another leg coming, right? Then you might see some of these Thai SDR running as well, okay, in tandem, right? So, how do you find out more about CPO, considering that it is listed in Thailand? Okay, don't worry about that because you can go to their company website or you can go to Stock Exchange of Thailand. They have a lot of all this information. And CPO, every quarter results, they will produce in presentation slide. And a lot of all these screenshots, all these I take from their slides. Okay, all these I take from their slides. And they're in English. Right, so you don't need to learn Thai in order to invest. Okay, so that is a good thing, right? And this is the website you can go. They have an investor relation website where you can get all the annual report, presentation. Right? Even the website has an English version, so it's not an issue. Yeah, so don't worry so much about it. So summary, this CPO is a dominant retail player in Thailand. It has moat, or what we call competitive advantages. Right? They have dominant market position, biggest supermarket chain, biggest convenience store chain. Very hard to fight. You think about it, even in Singapore, you got NTUC, Sheng Siong, all this, right? You want to start a new supermarket chain, you think it's easy? Not easy, right? So that is what a dominant retail player looks like in Thailand. And it's a resilient business. We saw that in COVID, it continued to have, it maintained its revenue. Yes, the expenses went up, but they were still profitable and they still managed to give dividends during the worst of times. Okay, so it's a resilient business. Third, the profitability, we talk about it because of restructuring, the margin has dropped and they need to recover from it. And so far, the first quarter results is encouraging and they also show revenue growth, right? There's operational growth, not accounting growth. Lastly, now it's trading at fair price, but if the fundamental continue to improve, the chance of CPO being undervalued is increasing. Okay, I think their second quarter results is going to come out in 2 weeks' time. You can also assess that again, right? Look at the results. I believe it should show recovery as well. Okay, so this is they are in a good position, I would say. So now let's talk a little bit about the product. Let me check the time. Okay, just nice. So let's talk a little bit about what SDR is, and I always prefer to use this chain so that we can understand how it flows. How does the SDR actually get to our side, right? So we know that this is, at the end of the day, is a Thailand company. Okay, so let's use CPO as an example. So CPO is traded in Thailand. Okay. In Thailand, there's this version or this class of shares called the non-voting depository receipt. Okay, you know, by right, when you own a share, you have a voting rights, correct? Okay, so in Thailand, there's this non-voting version of the shares. And this is the one that the SDR issuer will use and park it in the Thailand custodian, and they use that shares to create the SDR in Singapore. Understand? Okay, so which means your SDR is backed by actual underlying shares in Thailand. It's safeguarded there. Okay, then the SDR issuer All right. In this case, this SDR issuer for these three Thai names is Philips Securities, okay, which is one of the largest brokers in Singapore. So they create the SDR, and that's where it's traded on SGX. You can use your normal broker to buy and sell this SDR as usual. Okay, in the SGX ecosystem. Same trading hours, the SDR is priced in Sing dollars. Okay, so there's not much difference as though you trade like a normal Singapore listed company. Okay, it feels the same. Brokerage fee, everything the same. So once you buy, if you use a custodian, then the SDR will be parked with the custodian. If you use your CDP, then you will park in your CDP. Okay? And that's your Thai SDR that you eventually own as a investor. Got it? Yeah, so it takes a few parties, but you can see the flow and the relationship. Yeah, so let me run through a few common, frequently asked questions, just in case you're going to ask. Okay, I ask myself first. So first, does it give dividend? Do you receive dividend? Yes, you will receive dividend if they distribute dividend. In Thailand, there's a 10% dividend tax. Okay, so if you buy directly from Thailand, you also get a 10% tax. You cannot run away one. Right, this is a withholding tax. And then there's also an additional 1% handling fee, because for overseas script, it's usually like that. For a lot of brokers, even you buy overseas stock, you also will incur this handling fee one, most of the time. Okay, so it's as though it's the same, whether you buy directly or you buy the SDR. Second, common question: what are the benefits of buying SDR if I can buy the stock directly? Correct. Common question, huh? Few the benefits are this, right? Not limited to just this. Okay, first is that familiarity with SGX ecosystem. So especially if you have bought or sold stocks in SGX before, it is the same experience when you buy and sell SDR. It is literally zero difference. Okay, same broker, same brokerage fees in Sing dollar, store in a custodian or a CDP account. Okay, same experience, right? Even the dividend handling as well. Right, so if you use custodian, then they'll pay out to your brokerage account. If you use CDP, they'll pay out to your bank account. Okay. Second, it has longer trading hours than Thailand trading hours. Okay, so which means you have more window to buy and sell. Right. Third, it trades in Sing dollar. It minimizes the need for forex conversion. It depends on some broker. Some broker requires you to convert first, then you can buy, right? Some brokers can offer you to convert later after you buy, right? But the problem is usually you wouldn't know what is a forex if you convert, especially if you convert later, okay? But whereas when it trades in Sing dollar, it's a lot simpler. You don't need to worry about the forex. Yes, there's actually still forex risk, okay? There's still forex risk, just that the forex spread is smaller usually, okay, compared to if you convert it yourself. Fourth, doesn't need a broker to just assess the specific market. In this case, it's a Thai market. And not all brokers offer Thai market access. Right? Imagine you have to open another account and then you have to park money there and then you just have to buy the Thai stocks. There's a lot of administrative headaches. Okay, not worth it. And lastly, lower trading fees, because usually overseas, if you buy overseas stock, it incurs more fees. Okay, whereas if you just trade in Singapore exchange, Singapore exchange as well as in Sing dollar, your fees are generally lower. All right. Okay, last one. Would SDR suffer similar issue as with CLOP? Okay, how many of you remember CLOP? Only a few, huh? Oh, you're very young. Okay, very good. Okay, so this happened many donkey years ago, right? Okay, probably, I don't know, maybe you all not born yet. So that's why you all don't know. There was this club trading in Singapore that trades the KL listed securities. Okay, and thereafter it was sort of like banned, right? During the Asian financial crisis, that was in 1997. And Malaysia said that they have neither approved or endorsed this club trading. It was a one-sided affair from Singapore, so they announced that it was illegal to do it and they disallow it altogether. So a lot of those investors who were burned by this club issue would have remembered and worry that is this a similar thing, right? Because it sounds similar, you're investing in an overseas script, but this is based in Singapore. So the difference is that this depository receipt, right, is recognized by both of the exchanges in Thailand as well as Singapore, right? And even an MOU has been signed, memorandum of understanding has been signed, so there's black and white that both sides have acknowledged, right, and agree that this is going to be traded on both countries, right? Because in the Thailand side, they also have some Singapore counters trading there, okay, so it's mutual, okay? So that's why I think that it is very different case as with the last time, right, which was a more Wild case, Wild West, Wild East probably, okay, during those days. And that was also because I think in the earlier days when especially Singapore split with Malaysia, the Singapore market was even less developed than the Malaysian market. So Malaysian market was a more attractive one. So that's why they did this clock, right, to increase the trading volume. But I think now reverse already. I think Singapore market is a lot more matured than the Malaysian side. Okay, so that is the history. These are some resources, additional one that you can use, right? So SGX Academy has compiled quite a lot of them. You can use the link or the QR code, all right? As well as this is the SIP, but don't worry because this SDR is not under SIP. Okay, SIP means that either you have the experience or the knowledge to trade these products, else you need to take a test to pass it, then you can trade. But this SDR is non-SIP, which means you don't need this requirement, right? But just in case you like to trade this SIP product, DLC, ETN, futures, options, structured warrants, synthetic ETFs. Okay, if all these you don't understand what they are, don't need, okay? Don't worry. SGX Invest Telegram for updates, you can also join. Okay, so I just leave it there. Yeah, that's the last slide.